ExxonMobil and Chevron are interesting oil stocks to consider, especially as the price of oil has been decreasing, and OPEC, the Organization of Petroleum Exporting Countries, has signaled that they want to increase output to increase market share, even if that means lowering prices in the near term. They feel that that's what strategically is important for them over the longer term to push out some of those shale producers in the United States that have a higher cost to extract the oil from the ground compared to their reserves. So it's an interesting time to consider these oil companies, and I'll compare them on several important financial metrics, including revenue, operating margins, returns on invested capital, and then I'll look at valuation and I'll make a determination of which one of these two oil stocks makes a better investment at current market prices.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so looking at revenue growth for these two over the previous decade, they have increased revenue, but not all that much. So ExxonMobil has increased its revenue from 241 billion to 330 billion. That's good for a compounded annual growth rate of 3.3%. Remember, these are cyclical businesses. Oil prices are extremely cyclical. When worldwide economies are growing more quickly, oil prices usually follow higher. When worldwide economies are not growing as quickly, oil prices usually decline. That's because oil is used in several components. People travel more, people drive more, oil is used more in production facilities, etc. And so it's understandable that it's connected to economic output. But oil is also supply constrained inorganically. It's not naturally supply constrained, it's inorganically supply constrained by several of the countries that have large oil reserves that are represented by OPEC. They control the output. They don't produce as much as they're capable of producing. They produce as much as they think is strategically perfect for them. And so you have a two-sided equation with oil. Demand is volatile and output is volatile. And so that creates a situation where you have volatility on both sides of the equation. Chevron, meanwhile, has increased its revenue from 123 billion in 2015 to 189 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 4.7%. So low to mid single digit growth for these two oil companies over the previous decade with volatility embedded. The next metric I wanted to compare these two on is the operating profit margin. And similar with revenues, operating margins have been volatile. In the most recent periods, 11.6% operating profit margin for ExxonMobil and 10.3% for Chevron. These companies are very capital intensive. You hear me sometimes talk about the attractiveness of those asset-like business models, those platform-type stocks. These are not those. These are very, very capital-intensive businesses that require large capital investments almost all the time to maintain facilities, to add new facilities, etc. It's always going to be that kind of way. Although risk is decreasing in these industries as technology is helping operations become more efficient and not so risky in terms of searching and discovering and extracting. All of that has been improved in recent years with advancements in technology. The next metric I wanted to compare these two on is return on invested capital. And here's a metric where ExxonMobil shows a bigger advantage than in any other one of these metrics. As you've noticed, these two are very close in several critically important metrics. ROIC of 7.3% for ExxonMobil is ahead of the 5.4% for Chevron. So finally, let's look at valuation, and you'll notice valuations for these two companies have increased over the years, and it's usually counter-cyclical because earnings drop during poor economic times when oil prices are lower. And so the valuations increase because the expected earnings per share decrease and the stock price doesn't always decrease when the price of oil decreases because investors understand that it's a cyclical business and they value these businesses based on what they expect oil prices to be over the next decade rather than what they expect oil prices to be just for the next year. So ExxonMobil and Chevron, their valuations have increased since 2022. They're now trading at a forward price to earnings of 18.6 for Chevron and a forward price to earnings of 16.2 for ExxonMobil. So these two companies, they're not going to double your money overnight. These are more like long-term investments with steady dividends that are likely to increase. The current administration has been more favorable to the oil industry, and the removal of those incentives for electric vehicles and the increase in willingness to allow for more oil extraction is positive for the industry overall. It's a close call between these two. This isn't one of those easy choices. If I had to pick one of them, I would pick ExxonMobil. In fact, I own ExxonMobil. I've owned it since 2020. If you recall, when oil prices crashed and turned negative for a brief moment in 2020, a very unique situation. I was able to scoop up some ExxonMobil shares for very, very cheap, and I've held them since 2020. But it's a close call between these two, and it makes a solid addition to your portfolio as something that can de-risk your personal finance, especially if you don't own any oil stocks. Adding one of these could provide some risk reduction because if oil prices increase, you're going to be paying more price. You're going to be paying a higher price to fill up your gas tank, but then the stock price of your oil stock will likely increase, offsetting your risk. And the opposite will also be true in most cases. So it does provide some risk reduction to your personal portfolio, to your personal finances, by having at least one oil stock in your portfolio. And for me, I would go with ExxonMobil, but it's really close, so it wouldn't make a big difference. And I don't think if you go with Chevron instead of ExxonMobil, no one is forcing you to pick only one of these two. But in just a hypothetical scenario, I did the comparison in this video so you can see my analysis and my decision and which one I would prefer.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.